One of the articles that prompted what I think will be a great conversation for you guys to learn about listening to us here on the show today is an article that came out of the AP. 80% of mortgages pay taxes and insurance through escrow. I cannot tell you how many calls and emails we get every year from customers sending us a nasty gram sometimes about how their payment went up so much.
Right.
And wanting to know why their payment went up. And I'm sure you get the same thing.
All the time.
And I think there's a lot of confusion from people about how the process works. But, you know, when you're getting a mortgage, you have the option, if you put down a certain amount of money,
Correct.
to where you can pay your taxes and insurance yourself annually, which I personally think is the best option if you have enough capital to put down, and if that's a choice you make. Because then you're not dealing with people messing up the accounting or estimates or any of that kind of stuff. You stroke a check every year and it's less hassle. But the reason your payment in a lot of situations can move is because your insurance or your taxes go up, and then your mortgage lender, who estimated in a lot of instances what your tax bill or insurance would be, has to charge you for that amount, and they rectify that through increasing your payment, or in some instances, decreasing your payment. Let's say your taxes go down because, you know, in Florida, we have the homestead exemption. If you bought a house that didn't have a homestead exemption on it, and the taxes were higher, when you homesteaded, those taxes could come down, and in essence, your payment comes down. Same thing, insurance. Your insurance could go up or go down. It tends to go up more than it tends to go down, but going down, it does happen. So your payment can fluctuate because of that, and they do what's called an escrow analysis, where they determine
Right.
what's in the account, what they've taken from you in payments, to determine, to make sure there's enough to pay those bills there. If there's not enough to pay the bills there, they pay the bills, and then they take it back from you.
Right.
So there's a lot of confusion over that, where people don't understand that their taxes and insurance their payment isn't going to stay the same every year.
Right, yeah, if you have a fixed rate mortgage, you know, the principal and interest portion is never going to change. So if you ever see a change in your payment, it's one of those two items. It's either your insurance or your real estate taxes. And, you know, we get that call all the time as well, especially when the new tax bills come out. And it's exactly what you said, where, you know, it more so in our area, I think, than, you know, me in Virginia, for instance, the taxes changed very little ever. But here with the homestead exemption, you know, not only, you know, getting the homestead exemption or losing it, you know, with the homestead exemption, it's capped at how much the assessment can change.
Sure.
So when it changes ownership, and I've seen this as well, you know, in an area, you know, maybe someone's lived in the house for 20 years, their taxes are really low compared to the home's value.
Dramatically.
Right, so it gives the county the opportunity to reassess once it changes hands. So there could be a change there too. And one of the things that I do my best and always make it a point to bring up to my borrowers is, you know, hey, there's a good chance your taxes are going to go up. So I want you to at least be prepared for it. And I know Hillsborough County, for instance, they have the property tax estimator on their site. It's a great site. You can go in there and kind of check it out on your own.
I think the scenario where the taxes go down is when you buy a property that's not been homesteaded.
Right.
Homestead. But outside of that, or if you're you know, there are a lot of exemptions, like there's a disabled veteran, there's a widowed spouse, there's all kinds of other exemptions that could knock it down too, where you don't get that benefit when they first estimate them, you know, from the mortgage lender. But what I'll tell you, I think, you know, the first thing that you need to do when you see that happen isn't contact your real estate agent.
Right. They can't do anything about it.
There's nothing they can do. In fact, they're going to explain this to you, but in reality, what you need to do is get the login for your mortgage lender, go online and look at the account statement, and see what's come out and what's due, and then compare that. I've seen them make mistakes, you know.
Right.
Compare it with what's at the county. It's also a double check for you to make sure you're getting the exemptions you're supposed to get. Go onto the county, go to hillstax.org or, you know, the Pinellas, you know, tax.org, and look at what is owed for you, you know, in taxes, and compare that with what they have in your escrow account. One other thing that people make the mistake of, or they don't factor into the equation with that, is that, you know, sometimes they don't pay the bills on time.
Right.
You know, and then, or they don't pay them early. So the maximum savings you get sometimes isn't capitalized on when you're in an escrow situation. You're not going to be able to dictate that. You're not going to be able to call up your lender and say, hey, I want to make sure you pay them by the early date so I save money.
Right.
They're going to pay them when they want to pay them. And if it costs you more, they're just going to charge it back to you. You know, and there's interest that's lost. It's not a large amount of money, but there's a little bit here and there, and it can add up over time. So it's why I'm a big proponent of, you know, I'm a big boy. I can pay my own bills. You know, if I put down enough money for a mortgage, I don't want to have the lender controlling paying my bills because they screwed up a lot. And I can't tell you how often they do screw it up, where they pay the wrong bill, where they don't pay the bill, where they send a check somewhere else, where, you know, all kinds of different things can happen. So unfortunately, I think it's 20%. I think you have to have 20%.
It is. Yeah, most lenders require, you know, in order to waive escrow, a 20% down payment, you know, on the initial loan. So
Right.
If you have the ability to do that, it's definitely a good option to look into. But, you know, not only does it keep your mortgage payment itself lower, but it reduces the amount of money you need for closing as well, because on the lending side, we don't have to set up that initial
You don't have to
escrow
collect
account for
that
you.
amount for
Right,
the
exactly.
monies to be funded initially. One other thing, so you know, so that I think that's an important thing each year. If you see your payment change, that's why it's because of that. Or your adjustable rate mortgage could adjust.
Right,
That could be there's going to be details in the notice about why. But a lot of times it's related to your escrow account and the mortgage lender, your real estate agent. We don't have anything to do with it. We can't fix it. We can't change it. Calling and yelling at us and blaming us for not explaining it to you. We are not an agent of the mortgage. We have nothing to do with it. You know, so I think that's where you know, it's you know, your job as the owner to kind of do your due diligence and research and look it up and figure it out and take responsibility for what the right path for you is. If you're selling a home, this is another one that gets missed. If you're selling a home, you want to know what's in your escrow account because you're going to get some of that money back.
Right, exactly.
And you need to factor that into your math. A lot of sellers don't factor that into their math. And granted, it may be $1,000, it could be $4,000, it could be $10,000. It's in escrow. You want to know what that number is because you know the numbers in your head. You may not be factoring that in terms of what you want to sell the home for, what you want to net out of the process. So it's great to get a random surprise of money, you know, that you forget about. But it can also happen to where you don't get it at all. It gets lost in the mail. They send it to the wrong address. All these types of things do happen all the freaking time. So if you're selling your home, make sure to know when you put it on the market, know what's in that account, know when those bills are due, and then ultimately know what's due back to you. It's pretty simple math. You can print out the statement. You can see when the taxes are due. And then ultimately you also know, you know, how the closing costs can adjust, because sometimes if it's during a time when a lot of the tax bills are paid, you know, your escrow account could pay that, or it gets paid at closing. What if it gets double paid and you don't double check on that? So there's a lot of things that happen post-closing that as a home seller you have to pay attention to, including making sure you get all your escrow money back and making sure you don't double pay on anything. You know,
Right, and lenders are required to send those back within a certain time frame. So just kind of backing up what you said, you know, if you're selling, I would recommend, you know, calling the lender, you know, this is going to be my new address. Please send my escrow refund to the new address.
Making sure they know that. You know, we had a situation a few years ago where a customer never got their money back, and then it was unclaimed money with the state. And they ended up getting it.
Right.
What was funny is the lender paid interest. The lender had to pay interest on it too.
Oh, wow.
The interest wasn't that much, but nonetheless, it was, you know, there were unclaimed funds because they didn't follow up and they just never do. And then one day they're like, oh, I'm going to go on this website and search, and then sure enough, there was money in their name there. But the reality is you'd probably rather have that, and it was like $9,000. It was substantial. So you'd probably rather have that now than later. So make sure you're crossing those paths and checking on those things as you're going through the closing process and as you're putting your home on the market to know when and where those monies are going to come out. Because, you know, the escrow situation, you know, and the one problem with it is some banks do a great job, some banks do a terrible job. So, you know, my personal opinion is just, you know, I just don't like to rely on other people to pay my bills if I have to, you know. Now, if you're an FHA or lower down payment borrower, you're not really going to have a choice. But stay on top of that account. Look at your escrow account. Look at it. You know, put a task on your account. Look at it every few months. Make sure they're paying the bills. Make sure they're doing the right things. And then, you know, ultimately you'll be a better informed, you know, seller at some point in the future, because you'll know how that works, and you'll understand when your payments go up that no one's attempting to screw you, that no one lied to you, that simply a bill that you agreed to at closing to pay out of your payment went up.
Right, absolutely.
It's that simple.
Absolutely. One thing I was going to say too on the seller side, it may not hurt to have the conversation with your current mortgage holder as well to ask them if they do refund your escrow or if they deduct it from your
Proceeds.
mortgage. Right, from
Some
the
do
payoff,
deduct
right.
from proceeds,
It's
correct.
rare that it happens, but
But
I
sometimes it
refinanced
do.
my house in Virginia one time, and on the payoff, they actually deducted the escrow balance from that as opposed to refunding the money to me.
Yeah. Well, we're going to continue this conversation with Mike Yates from Atlantic Bay Mortgage. I'm Andrew Duncan with the Duncan Duo at RE/MAX. We talked in the first segment about escrows with your mortgage and you know what that looks like in terms of insurance and taxes and the impact on your payments. We're going to talk after the break. We're going to talk about some real estate technology, which I think is really important and kind of changing the game a little bit, as well as the unaffordability of our real estate market and what that looks like for the future of Tampa real estate. After a quick break here on 970 WFLA.